Namaste. In this video, we'll discuss about India's one that talks about the presentation of financial statements. So, the objective of India's one is to prescribe basis for presentation of financial statement, as we have already discussed in the earlier video regarding the introduction to India's. That focus of India's is to bring the comparability among the financial statements of different entities. So, it ensure the comparability with the organization, with the different years, and with other organization, and it provide the useful information about the position of the company, performance of it, and the cash flow statements. And with its uniform concepts and principles, it enhance the understandability and transparency. The scope of India's one is it applies to all general purpose financial statements. It may not apply to the specific purpose financial statements, but it applies to the general purpose financial statement. It covers the balance sheet, profit and loss account, equity, cash flow, and notes. And it applies to all entities. Those are under India's framework that we have already discussed in our earlier videos, Introduction to India's. And it does not cover recognition and measurement principles, because recognition and measurement principles are taken care by respective accounting indices, and it does not apply to the structure and content of the condensed interim financial statement that is dealt by Ind AS 34. Purpose of financial statement is to provide information about the financial position of the company, its performance, and about the cash flow statement of the enterprises. So, what is the complete set of financial statement? It is balance sheet, P&L with OCI, and changes in equity, cash flow statement, and notes to the accounts. So, and there should be comparative information when financial statements are presented, and there are some requirement that will be discussed in the next slides to present the third balance sheet in the cases where retrospective application or restatement has been done by the enterprises. So general features of the financial statement, first is that it should present the true and fair presentation and should be in compliance with the accounting standards. So financial statement must fairly present the financial position and performance and cash flow, and it will happen when it is in compliance with the accounting standards. When it is in compliance with the accounting standards, India says it is presumed that they are presenting the true and fair presentations, and management need to give explicit and unreserved statement of compliance of Ind AS while presenting the financial statements. And enterprises cannot claim compliance unless all the Ind ASs are followed. And departure from Ind AS is not allowed. It is allowed only in extremely rare cases where regulatory frameworks allows it. And when there is a departure from the Ind AS requirement, we must disclose the standard that has been departed, reason for departure, and nature and financial effect thereof. Next, general feature is about the going concern and accrual basis. When we are making the financial statements, it is prepared on the going concern assumptions. We are not supposed to follow the going concern assumption only in case where the liquidation is intended and enterprises is going to cease the operations. In these conditions, we are not supposed to follow the going concern assumption. Otherwise, management will follow the going concern assumptions when preparing the financial statements of the enterprises. If we have not followed the going concern assumptions, in that case, enterprise need to disclose the reason and basis of why it is not going to follow the going concern assumptions. Where the enterprises has followed the going concern assumption, but there are when it has judged or measured the going concern concept of the entity, and it is found that there is a major uncertainty casting significant doubt on the ability of the continuity of the organization business. In that case, although in next 12 months it does not see any major breakdown in the operation, ceases in the operation, but there is a doubt. In that case, although it has followed the going concern assumptions, but it need to disclose its assumptions about the major threats that may happen to the going concern concernity of the enterprises. And all the documents except cash flow statement are to be prepared on the basis of accrual assumptions. Next thing is about the materiality. So in the financial statements, all the material items to be presented separately, and offsetting of different items is not allowed unless or otherwise Ind AS permits it. For example, we cannot offset the income and the expenses. We need to present separately income and the expenditures. But where we have incurred some expenses and it is to be uh, reimbursed by some other entity, in that case we can net off the expense. For example, we can net off the expense if we have contract with the entity to whom we are either supplying the material as well as purchasing also. In that case, based on the nature of the transaction, we can net off the AR and AP. And items of dissimilar nature or function should be presented separately unless they are unless immaterial. So it means that items of immaterial nature can be aggregated. So there is an aggregation rule also that immaterial amount can be aggregated with other amounts in the financial statement, and financial statement should be qualitative and quantitative materiality. Even material items should not be aggregated if it obscure useful information. If something that is aggregated and result into the obscure of financial statement, in that case it will not present the true and fair presentation. So omitting, misstating and obscuring is prohibited. And material is not just about the size. It is not about always the quantitative information, but also about the nature also. For example, a small transaction may be material if it relates to the director or related party. So we need to check about the qualitative and quantitative materiality also. Management must apply judgment in assessing materiality considering the needs of the user of the financial statements. And we need to present, we may present additional line items, heading, subheading when relevant to understanding of the entity's financial performance and position. Next is about the offsetting that we have already discussed, that offsetting is not allowed unless Ind AS permits it, and offsetting is allowed if substance reflect, and measuring assets net of allowance is not offsetting. For example, showing the inventory net of the valuation allowance is not called offsetting. Next is about the frequency of financial statements. It should be presented annually. And if the period of the financial statement is not equal to 1 year, we need to disclose the reason, and we need to disclose about the comparability issued, or that amount presented in financial statements are not entirely comparable. Otherwise, in normal course, financial statement will be presented for 1 year. Next is about the comparative information. There should be minimum comparative information. Comparative figures in respect of the previous preceding year should be presented, and it will include the comparative figures will be included in corresponding notes and disclosures also. And similarly, it will be presented in balance sheet, P&L, SOKI, cash flow and other notes. We may present Enterprises may present additional comparative information, and extra period can be presented voluntary. But we need to take care that it does not result in obscurity of the information. And it must comply with the Ind AS and should have equal prominence when presented. Next is, it should not obscure understanding of financial statement that we have already discussed. Next is going policy change, restatement and reclassification. So we need to present third balance sheet When entity applies the accounting policy retrospectively, or it restate items retrospectively, or it reclassifies items and effect is material at the beginning of the earliest period presented. In that case, we need to present third balance sheet. So third balance sheet will be presented at the in the third balance sheet there will be at the end of current year and at the end of the preceding period and at the beginning of preceding period. So we are supposed to present third balance sheet in case of policy change, restatement and reclassification. And reclassification of the comparative, we need to disclose the nature of reclassification, show the amount reclassified and need to explain the reason for reclassification. And if it is impractical to reclassify comparative figures, in that case, we need to disclose the reason and the nature of adjustment, that why it is impracticable to disclose the reclassify the comparative figures. So now we will discuss about the format of balance sheet. So in division 2 of format that given in the schedule 3, balance sheet starts from the assets, and this assets is classified in two categories. One is the non-current assets and current asset. And in non-current assets, first the non-financial assets like property, plant and equipment, capital work in progress, investment property, goodwill, other intangible asset and intangible assets under development are shown. So if you see that all these assets are of non-financial nature. So in non-current assets category, first the non-financial assets are presented, and under the non-financial asset, if you check, the property, plant and equipment and capital work in progress and investment property are tangible in nature, and these three are intangible of nature. And next category that is presented in the sequence is biological asset, and in biological assets it is other than bearer plant. So bearer plant are included in property, plant and equipment category here. So be other than bearer plant will be covered here, and bearer plant will be covered here. So this we will understand in the agriculture and AS. So the consumable category is presented here, and non-consumable category is presented with the property and plant in tangible category. And thereafter, financial assets are being presented, investment, trade receivable, and loans. Thereafter, deferred tax assets and remaining assets are presented. So this is the structure of balance sheet. And in current category, first, non-financial assets are presented similar to non-current category. Thereafter, financial assets, investment, trade receivable, cash and cash equivalent, and bank balance other than the cash and cash equivalent is presented here. Thereafter, DTA and other current assets are presented. So this is the asset side of the category. If we check again, discuss again, first assets category is divided into non-current assets and current assets. Thereafter, non-financial assets and biological assets, financial assets, DTA and others. And in non-financial category, there is further bifurcation between tangible and intangible assets. And if we look at the balance sheet side, it is equity and liabilities. So first, equity and liabilities are presented, and liabilities are further classified in non-current and current categories, and equity is classified in equity share capital and other equity. Here if you check, the name is equity share capital, not the share capital as earlier it was. So here we are not and for detailed movement of equity and other equity, we need to present the statement of change in equity SOKI for detailed movement of it. And part 1 of SOKI represent the equity movement, and part 2 reflects the other equity movements. Here we need to check that preference shares are not part of the equity share capital. Here equity word is specifically mentioned. Why it is not there? It will be part of, in most of the cases, it will be part of the non-current or current liabilities, because the nature, it will be classified based on the nature. If it is in the residual interest nature in the entity, it will be classified as equity. Otherwise, it will be classified as borrowings. And in non-current assets, liabilities, it is again classified as financial and non-financial. In the asset side, non-financial were presented first, but in liabilities category, first the financial liabilities are presented. So in financial liabilities, there are borrowings, lease liabilities, trade payables, and under trade payable, there is separate classification for MSME payables. And similar to asset side, again the DTA and other non-current liabilities are presented. So this is all about the presentation of balance sheet as per division 2 of schedule 3, that is in compliance with accounting standards. Indian accounting standard Indias. Next category is we need to classify, as we have seen that asset side also and liability side also we need to classify in current and non-current category. So how this classification is done, we need to discuss it in this slide. So classification of asset in current and non-current category is done based on the operating cycle. So operating cycle is a time between the acquiring asset for processing and converting them into cash. For example, if we are acquiring the raw material, so and it will take 4 months in converting the raw material to finished goods, and it takes 2 months to sell the finished goods, and again 2 months to the realization of debtors. So total of all these things from the procuring of the raw material to the realization of cash is called operating cycle. Similarly, it is defined at time between the acquiring assets for the processing and converting them into cash is called a operating cycle. So based on the operating cycle, assets and liabilities will be classified into current and non-current category. So for the assets category, if it expect to realize or intend to sell or consume in normal operating cycle period, it will be classified as current category, current assets. So if you check, expect to realize, it intends for the debtors and intend to sell, it is FG, and consume in normal operating cycle, it is raw material. Second is if it is held for the trading, it is maybe trading assets, and it expect to realize within 12 months after the reporting period, it will be classified as current category, and cash and cash equivalent unless restricted for the exchange for within 12 months will be classified as a current assets. So if the asset is going to be realized within 12 months or within the operating cycle, it will be classified as a current asset. Otherwise, it will be classified as non-current assets. So all assets, those are not classified as current. For example, PP, intangible, long-term investment, deferred tax assets, etc., are categorized as non-current asset. In case operating cycle is not clearly identified, in that case, we assume that it is of 12 months. And all asset expected to be realized, sold, consumed within operating cycle, even though operating cycle is more than 12 months. If operating cycle is 24 months and debtors are going to be realized, expected to be realized within 24 months, then it will be classified as a current assets. Next is about the liabilities. It will be also classified between current and non-current category. And if enterprise expect to settle the liability within a operating cycle, it will be classified as current. And if it is held for primarily for trading purpose, and it is due to be settled within 12 months from the reporting period, or entity has no contractual right to defer settlement beyond 12 months, it will be classified as current asset, current liability. And all other liabilities, those are not classified as current, like pension obligation, deferred tax liabilities will be classified as non-current. Deferred tax, whether it is an asset or liability, will always be classified as non-current asset. And if we check other related provisions, operating cycle rule is similar if it is going to be settled within a period of 12 months. And if borrowing is due on demand, it will be called as current. Second, if there is a breach of covenant in case of the borrowing and lender has formally granted grace period or has refinanced it before the reporting period date and the period is more than 12 months, in that case, it will be classified as a non-current. Otherwise, if borrowing is due on demand or there is a breach of covenant and the loan has been converted to due on demand, in that case, it will be classified as a current. And if there has been a breach of covenant and lender has agreed to provide extension of grace period that is more than 12 months from the balance sheet date, in that case, it will be classified as a non-current asset. Next thing is, if this India talks about the breach of covenant, it does not talk about the expectation of breach of covenant. So in case if there is an expectation of breach, but there is a no breach till the reporting date, in that case the liability will be classified as a current. So it will not, principle will not apply based on the expectation of breach, but it will be apply based on the actual breach of covenant. Next is refinancing after the reporting date do not affect the classification because refinancing agreement after the reporting date has been completed and after completion after reporting period is a non-adjusting event as per Ind AS 10. Next, if refinancing rescheduling agreement exists on or before the reporting date, in that case we will classify it as a non-current asset if period is more than 12 months. If there is a conversion option, liability convertible into equity within 12 months at holder's option, we will classify it as a current. If settlement cannot be deferred unconditionally beyond the 12 months, we will classify it as a not current. So in case of assets, there is a classification based on the expectation, but here we it is based on the right to unconditionally defer. If lender does not have right to unconditionally defer the liability that has become due, it will be classified as a current liability. And if it can defer unconditionally the liability settlement for more than 12 months, in that case it will be classified as a non-current. So let's take some example. Entity XYZ is a large manufacturer of plastic bottles for local market. As on April 2006, the newly elected government unexpectedly abolished all the import tariffs, including 40% tariff on all the imported plastic product. Many other economic reforms implemented by the new government contributed to the value of the currency appreciating significantly against the most currency, and the currency appreciation severely reduce the competitiveness of the entity's product. Okay. So in 20x6, entity XYZ was profitable. However, because it was unable to compete with the low price import, okay, it resulted into losses. And in X7, entity was loss was this much. During the second quarter of the financial year ending, the management restructured and losses for the third and fourth quarter reduced to 400, 300 respectively. Okay. During the year ended March 2007, entity XYZ reported a loss of 4,000 in January. Local plastic industry and labor union lobbied government to reinstate tariffs on plastics. On March 2007, the government announced that it would reintroduce limited plastic import tariff at 10%. However, it emphasized that those tariffs would not be as protective as the tariffs enacted by the previous government. In its latest economic forecast, the government predicts a stable currency exchange rate in short term with a gradual weakening of jurisdiction currency in the long term. Okay. Management of entity XYZ undertook a going concern assessment. Management project forecasted imposition of 10% tariff on the import of plastic would at current exchange rate result in XYZ returning to the profitability. So it means there is a no concern about the going concern. How should the management of entity XYZ disclose the information about the going concern assessment in the entity XYZ 2007 annual financial statement? So, as we have discussed in the going concern concept, that if there is a no concern, company is not going to cease its operation. In next 12 months, the documents, the financial statements will be prepared based on the going concern. But management need to present the major threats if it has any related to the operations of the company. So let's see what the solution says, that entities ability to continue as a going concern, that entities shall disclose these uncertainties, and entities required to disclose the fact if the financial statements are not prepared on going concern basis, along with the reason that why it is not being prepared. But in this case, that entity will prepare the financial statement on going concern basis, because there is a no threat to the going concern, only the threat, material threat persists, so we need to disclose that. Next is, if offsetting of revenue against expenses permissible in case company acting as an agent and having sub-agents where commission is paid to the sub-agents from the commission received as an agent. So as we have discussed, offsetting is not allowed unless or otherwise it is permitted by Ind AS, or the substance of transaction is like this. So if we net off the revenue from the expenditure from the revenue, it is not correct. So let's see what is the solution, as it would not reflect substance of the transaction and would detract from the ability of user to understand the transaction. So amount of commission paid by it to the sub agent should be considered as an expense and should not be offset against the commission earned by it. So next is about the operating cycle. We have already discussed how it is being calculated. So let's see some practical examples. XYZ provides you the following information, that raw material stocking period is 3 months, DIO is 3 months, working WIP holding period is 1 month, FG realization is 5 months, and debtors collection period is 5 months. So from the period of raw material to debtor realization will be the operating cycle. Let's see, 3 plus 1 plus 5 plus 5, it is 14 months operating cycle is there. So if any assets is expected to be realized within this period, it will be classified as current asset. Next is, inventory or trade receivables of X Limited are normally realized in 15 months. How should X Limited classify such current inventory, trade receivable, and as current or non-current if these are expected to be realized within 15 months? So in this case, the operating cycle is given is of 15 months. So if it is realized within this period, it will be classified as current. So B Limited produces aircrafts, and length of the time between the first purchasing raw material to make the aircraft and date of the company completes the production delivery is 9 months. So operating cycle is of 9 months. The company receive payment for the aircraft 7 months after the delivery. So production and delivery is 9 months and debtors realization is 7 months. So total It is 16 months. So what is the length of the operating cycle is 16 months, and how should it treated it inventory and trade receivable? So it is within the operating cycle of 16 months, so will be classified as a current. Next is on April X3 Charming Limited issued 1000 rupees 10 bond for this much amount on April 1st. Each year interest at the fixed rate of 8% is payable. So interest is payable within a period of 12 months. Okay. Uh, on outstanding capital amount of the bond, and the first payment will be made on 1st April. On 1st April each year, Charming Limited has a contractual obligation to redeem 1000 bond in its statement of financial position on X4. How this should be presented in the financial statement? So there are two things. One is the payment of interest, and another is the payment of the bonds. So it has issued 1 lakh bond, and each year at a rate of 8% it is payable, and outstanding capital amount of bond, the first payment will be on this. Okay. Contractual obligation to redeem 10,000 bond. So interest, Charming Limited must present 80,000 accrued interest and 1 lakh as a current position of non-current bond, because it is payable within a period of 1 year, and remaining 9 lakhs due later after 12 months will be presented as a non-current assets. So two items there, those are payable within 12 months, that is interest and 10,000. Redemption of the bond will be classified as a current, and rest of the amount will be classified as a non-current category. Next is X Limited provide you the following information, that raw material holding period is 3 months, WIP is 1 month, finished goods is 5 months, and debtor collection period is 5 months, and trade payable of the company are paid in 12.5 months. Should these be classified as a current or non-current? So we need to check first the what is the operating cycle. It is from the raw material to debtor collection period. So it is 3 plus 1 plus 5 plus 5. It is 14 months, and creditors are being paid within a 12.5. It is more than 12 months, but it is within a limit of operating cycle, that is 14 months total of all these three. So it will be classified as a current. As we have earlier said, that classification is based on the operating cycle. Entity A has two different business, a real estate and manufacturing of passenger vehicles. With respect to the real estate business, the entity construct the residential apartment for the customers. Okay. And normal operating cycle is 3 to 4 years. With respect to the business of manufacturing of passenger vehicle, operating cycle is 15 months. Under such circumstances, when an entity has different operating cycle for the different type of business, how the classification into current and non-current to be done? So when a company has more than one operating cycles, the assets, debtors, creditors will be classified based on the business operating cycle to which they relates. So in this case, there are two operating cycles. So assets related to real estate business will be classified based on the operating cycle of the real estate business, and assets, those are related to manufacturing of passenger vehicles, will be classified based on the operating cycle of the passenger vehicle business, that is 15 months. And real estate assets and liabilities will be classified based on the operating cycle of real estate business, that is 3 to 4 years. So this is an interesting example. An entity has placed certain deposits with the various parties. How the following deposits should be classified as a current and non-current? Electricity deposit, if it is expected to be realized Within a period of 12 months, it will be classified as a current. Otherwise, it will be classified as a non-current. And normally, the electricity deposits we pay with the intention for a long-term period. So it will be classified as a non-current asset. Tender deposits earnest money, it is again based on the realization of deposit. If it is expected to be 12 months, it should be classified as current, and if not, it will be classified as a non-current asset. And GST deposit paid under dispute or GST payment under dispute, it will be, if entity expect to realize it within a period of 12 months, it will be classified as a current. Otherwise, it will be classified as a non-current asset. Paragraph 69A of India states the entity shall classify a liability as current when it expect to settle the liability in normal operating cycle. Entity develops tool for the customer, and this normally take a period of 2 years for the completion, and the material is supplied by the customer, and hence entity only render a service. Okay. For this, the entity receives a payment upfront and credits the amount so received to income received in advance. So how should this income received in advance will be classified as a current and non-current. So in this case, the amount received in advance will be classified as a current liability, as we have already discussed that some liabilities, those are part of the working capital, will be used in working capital used in the entity's normal operating cycle period will be classified as a current, although they are going to be settled more than 12 months after the reporting period. Next is, an entity has taken a loan facility from a bank that is to be repaid within a period of 9 months from the end of the reporting period. Okay. Prior to the end of the reporting period, the entity and the bank enters into an agreement arrangement whereby the existing outstanding loan will be unconditionally rolled into new facility which expire after a period of 5 years. Okay. At the year end, if you earlier the loan that was taken was due for a period within a period of 9 months from the end of the reporting period, but prior to the end of the reporting period, so it is before the end of reporting period, company has entered into an arrangement to defer it for a period of 5 years. So how such loan should be classified in the balance sheet? So it will be classified as a non-current asset because it is due for more than 5 years after the balance sheet date. So if any liability is payable after 12 months from the balance sheet date, it will be classified as a non-current. Will the answer will be different if the new facility is agreed upon after the end of the reporting period? Yes. If before end of the reporting period, it is arrangement is done, it will be classified as a non-current. But if the arrangement has been done after the reporting period, so as we have discussed that it is a, as per India stand, it will be classified, it will not be considered as, so will be classified it as a non-current asset. Refinancing agreement after the reporting period is a non-adjusting event, so we have to classify it as a current asset, current liability, sorry. So will the answer to A will be different if the existing facility is from one bank and the new facility is from another bank? So let's check. Yes, the loan facility arranged with the new bank cannot be treated as a refinancing because there are different parties to it. And next is, will the answer to A will be different if the new facility is not yet tied up with the existing bank, but the entity has the potential to refinance the obligation? No. Unless or otherwise, company has undiscretionary power to defer the liability, it cannot be classified as a non-current. So when refinancing or rolling of the obligation is not at the discretion of the entity does not consider the potential to refinance the obligation and need to classify it as a current. In 2020x1, the entity entered into a loan agreement with the bank. The loan is repayable in three equal annual installment starting from X5. Okay. So loan was taken in X1 and it is payment to be started from X5. So it is more than 12 months. Okay. One of the loan convenient is that the amount equivalent to the loan amount should be contributed by promoters by X2, failing to which loan become payable on demand. As on March X2, the entity has not been able to get the promoter's contribution. On March X2, the entity approached the bank and obtained a grace period up to 30th June X2 to get the promoter's contribution. The bank cannot demand immediately repayment during the grace period. Okay. The annual reporting period of the entity ends on March X2. As on March X2, how the should the entity classify the loan? Here we need to check that whether breach of covenant has been done or not. So breach has not been done as on 31st March. In the present case, following the default grace period within which the entity can rectify the breach is less than 12 months after the reporting period. Hence, as on March X2, the loan will be classified as a current because it has got the grace period of till 30th June. Second is assume that there is an anticipation that it may not be able to get the promoter's contribution due by due date in Feb X2 and the entity approached the bank and got the compliance date extended up to 30th June X2 for getting the promoter's contribution. In this case, will loan be classified in March X2 will be different from above. So in this case, Indians deal with the classification of liability as current and non-current in case of breach of the loan and does not deal with the classification in case of expectation of breach. In this case, when the actual breach has taken place or not is to be assessed on 30th June to the X2, that is the reporting date. Consequently, in the absence of actual breach of loan convenient as on March X2, loan will retain it classified as non-current. OMN Limited has a subsidiary MN Limited. OMN Limited provide a loan to MN Limited at 8% interest to be paid annually. Loan is required to be paid whenever demanded back by OMN Limited. How should the loan be classified in financial statement of OMN Limited? Will it be different for MN? So the demand might be primarily a form of protection or a tax-driven feature of a loan. Both parties might expect and intend that loan will be remain outstanding, foreseeable because these are within the subsidiary companies. However, OML Limited would classify the loan as current if the both parties intend that it will be repayable within 12 months, and ML Limited would classify the loan as current because it does not have a right to defer the repayment for more than 12 months. And in case OMN Limited expect that it is not going to realize the loan for next 12 months, it will be classified it as a non-current asset. So it all depend on the expectation and intent of the loan for the OMN Limited. But for MN Limited, it will be classified because as a current asset, current liability because it is payable on demand. And MN Limited does not have absolute power to defer the settlement unconditionally. So next thing that we need to discuss is about the format of statement of profit and loss. So similar to the financial position, it is divided in continuous operations. So first we'll present the income, that is revenue from the operation, and other income, and then total of the income. So I have mentioned the logic to memorize it. We need to first present the income from the ongoing business, operating and non-operating. So I have classified that this block is for the continuous operations, that will be presented first, then the expense, and expenses will be also from the continuing business operation only. So first we need to present the COGS, cost of material consumed, that purchase of stock in trade, then change in the inventory. So all these three items are related to the inventory. Then employees benefit, finance cost, then depreciation of assets, other expenses, and it will be total expenses from the continuing operation. So to memorize it, consumption order of expenses is mentioned in this form: first raw material, then trading goods, then inventory change, that is devaluation, manpower, borrowing cost, asset uses in form of depreciation, and miscellaneous. So here also only operation or continuing operations are shown here. Then we need to present the results, profit and loss before exceptional items and tax. Then we need to present exceptional items, that profit and loss before PBT. Then deferred tax assets, then profit and loss for the period from the continuing operations. So here we have shown the performance from core operations. Then we need to adjust for unusual items, exceptional items, and apply tax. And this is the net continuing results, profits from continuing operations. Thereafter, we need to present the profit and loss of the discontinuing operations. Then we need to present tax separately. Then final profit and loss from the discontinuing operations. So discontinuing is shown separately in division 2 of schedule 3. Thereafter, we need to present the total results in OCI, profit and loss for the period from the continuing and discontinuing operations, then other comprehensive income, and it will further classified in non-reclassified to PL and reclassified to PL. So OCI portion we will separately see, because it is a little bit complex topic, and this is not the right time to explain it. When we will discuss different accounting standards and there is applications of OCI, so I will be explaining to you what is not reclassified to P&L and what will be reclassified to P&L, what separately. And so here total comprehensive income is presented. So logic is that earning plus OCI gives the true overall performance, and OCI is split between reclassified versus non-reclassified items. So next is we will present the EPS from continuing operations, discontinuing, and on total basis. So this is all about the Ind AS 1, that talks about the presentations of financial statements. So if you have any query regarding Ind AS 1, want to discuss about anything, need any clarification, you may contact on the WhatsApp number given on the screen. Thank you. Namaste.